Welcome back. It was an update for stocks, but Wall Street is closely watching for any broad impacts or escalations from the Israel-Hamas conflict. Treasury Secretary Janet Yellen weighed in on the potential consequences earlier in an interview with Sky News.
I think it's too early to speculate on whether or not there will be significant consequences. I think, importantly, it depends on whether the hostilities extend beyond Israel and Gaza, and that's certainly an outcome we would like to avoid.
Joining us now is Komal Sri-Kumar. He is president of Sri-Kumar Global Strategies. Sri, thanks for being with us. So you've written recently that getting inflation under control is going to be tough. The last mile won't be covered without a significant degree of pain. How does this geopolitical instability factor into that pain?
John, it's a very timely question. Even without the geopolitical uncertainty, it would have been difficult to bring inflation down from 3 to 4% down to the 2% target. Now, with oil prices going up, geopolitical uncertainties increasing, it makes it even harder for Federal Reserve Chairman Jerome Powell and his colleagues to do so. So I would say, if anything, the 2% is beyond reach for at least the next couple of years.
So when you look at, say, sectors in the S&P, are there areas of certainty, even in this broader uncertain environment, where you expect the traditional relationships to remain?
Normally, you would think during the circumstances, if you're very concerned about growth equities, that you would go into utilities, you would go into consumer staples to hide, to get yourself protection. This cycle, you have a different story. Bond yields are extremely high. 6-month Treasury bills have been yielding 5.5% or higher. So I think equities are facing a huge headwind, even the so-called defensive sectors, because of the fixed income opposition that they get, which is not the case generally in the past. So we are talking about a very different situation. Investors need to handle it, taking into account the importance of high-grade fixed income at the current stage. Because I don't think the 10-year yield is going to go out of control. It's not going to go to 5, 6, 7% like some people have been talking about. I think there is a natural ceiling. And you went back to the geopolitical uncertainty, John. That also puts a ceiling on it and keeps you from losing too much money in 10-year or 30-year securities.
Okay. Why do you think there's a ceiling? And I ask that because, yes, I realize, geopolitical risk premium, flight to safety, that makes bonds more attractive. But on the other hand, and you just talked about it, if inflation's not coming down for the next couple of years potentially, and you have the U.S. running at, record deficits, and we know conflicts, whether we're in them directly or just helping to fund them, are inflationary and require more spending. Doesn't that actually fuel the argument that you could see rates go higher?
Very good point. All of those do. But look at the other side of the equation. When you have geopolitical uncertainty, you want a safe haven. You want to protect your capital. And even if you're going to get a guaranteed minus 1% in real terms after inflation, you would rather have it than to lose money in equities under those circumstances. So I think with short-term Treasury yields so high, even if inflation stays high, you're still going to get somewhat of a positive real yield. So I think that's how I make continuing high inflation rates consistent with your ability to get returns in the fixed income market.